This is a podcast produced for EIS Platforms Limited, trading as growthInvest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investment, and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.
Hello and welcome to Alternative Thinking with me, Melissa Griffiths.
And me, Steve Dobson.
This is a podcast that takes a deeper dive into the alternative marketplace and explores topical issues. Today we're joined by James Lowe at Schroders Capital to discuss long-term asset funds, which are abbreviated as LTAFs. Lovely to have you, James.
Thanks for having me along.
So as always, we like to start with a bit of background on yourself, and also then we'll run through LTAFs.
Yep, so my name's James Lowe. I look after UK wealth distribution for private markets at Schroders. Schroders Capital, should just say at the start, is a slightly alternative brand to Schroders. Many people will know Schroders for the public markets business.
Perfect, okay. And obviously focus today is LTAFs. Could you briefly give us an update on the key features and the history to date? Because they're perceived to be a newer product, but actually they have been around for a while, haven't they?
They have, and so I'll give you a very sort of whistle-stop tour through the history. So we go back to 2019, actually. This is when Rishi Sunak was the Chancellor.
Yeah.
And this is when we, really started seeing this discussion around UK productive finance coming to the fore. There was the formation of the UK Productive Finance Working Group. This is a group of industry bodies, the FCA, the Bank of England, you name it. And this sort of set about thinking about different government policy initiatives and things like the LTAF. We're starting to see things in Mansion House, pension bill reform now all coming through sort of, 6 years later. But it all started back then in 2019. In terms of the LTAF didn't actually come into being until 2021.
Okay.
So this was a new UK authorised fund structure that the FCA has developed. It's specifically developed to invest in long-term illiquid assets. What do we mean by long-term illiquid assets? Actually, the FCA doesn't define it in the rule book. Doesn't define it. No, but that's quite intentional, I think. So, as asset classes develop, we might see new asset classes. You don't want to be too prescriptive about what long-term illiquid assets mean. But let's be honest, if you go and speak to a lawyer, they'll tell you it's private equity, infrastructure, real estate, private credit, venture capital, all the things that that would warrant having a longer-term time horizon if you were investing them, because generally, there's an association of illiquidity with those asset classes. Maybe to just build out on that, and maybe, I guess, bringing it back to why it's so relevant as a conversation now for the wealth market, for advisors, discretionary managers, and even maybe in the future for retail investors through execution-only platforms. In 2023, there was a consultation on the broadening of distribution rules of LTAF. So when they came into passing in 21, it was a pension structure, so built for the defined contribution pension market. In 23, we saw a review of that. This was actually always going to be the case. So, it wasn't that the industry suddenly lobbied the FCA to have a review. It was just that the pensions market was always going to be the first case. We then moved on to the retail market, and actually in June 23, we saw the consultation results, and that moved LTAFs from being in the most sophisticated category of product in the UK to a middle category, which effectively is called restricted mass marketing. And what does that mean? It's exactly what it says on the tin. It's the Ronseal moment. It's restricted and it's mass marketing. So you can mass market LTAFs, but in a restricted way. And the restricted bit's really key here. It puts quite a lot of restriction around execution-only retail investors. So if you wanted to go through one of the large platforms and buy an LTAF, that would still be direct promotions, like financial promotions, offer rules. So you'd have to do opt-ups, all those sort of things that are in place to make sure the right investors are investing in these products. What was changed, and this is the important point for this conversation, is advisors and discretionary managers can now buy LTAFs in a relatively less restrictive ways. So if you want to buy an LTAF as an advisor now, that has been put back onto you by the FCA. You just have to show your end retail customer certain risk warnings and summaries, and clearly do the suitability that you would normally do on any product. But it's been made a lot easier now since that rule change in 2023. And then finally, I guess full circle, since that rule change, we've now seen wealth, so retail appropriate LTAFs coming to market. So there's been lots of news and noise in the press around not much demand for LTAFs in the UK market. That's actually not surprising, because most of the LTAFs, the first LTAFs that were launched for the DC market. So they were structured for pension schemes in specific structures that only really work for tax exempt investors. So charities it work for, DC pensions it works for, but not for your traditional wealth market investor. And so we now start having LTAF OICs, so OIC structure, open-end investment company, which we're all familiar with in the mutual fund market. LTAFs are now being structured specifically and built for the wealth market. So there's a very potted history there. We've gone from 2019 and now we're sort of 2025, where we've had a couple of rule changes. Regulations have switched and made it reduced restriction, and we're now in a position where we have products in market.
So it's interesting, because I mean, it's still a relatively short period of time in financial history. And you mentioned there, obviously, the first products that came to market were targeted to the DC pension market, and there was probably low double-digit number of products out there and smaller number of providers like yourselves doing it. What is the key difference then with the product that is now being targeted towards wealth? Because as a platform, we're not seeing many in the marketplace. You mentioned the structure, kind of the ticket size that people can go in as well. How are the changes being made?
Yeah, so ticket size is a key one. So in the pension fund structure that I mentioned, it's generally $1 million minimum, which for most retail advice clients isn't going to work. So the LTAF minimums we're seeing now come to the market around 10K.
Oh, okay.
So much lower, which makes it much more accessible. In terms of other things that are different, as I say, the tax status of the product, key that you have the right taxation within the structure for a wealth market audience. And then also just a final critical point as well is that many of the pension structures that have been built as LTAFs, they are new products that have started from zero. So ultimately how that process has worked for us, and I know for other asset managers in the market, is that, large cornerstone DC investors, who have hundreds of millions to deploy into the LTAF market, and they'll seed it, and then we build that slowly over time, with private markets, there's this thing called the J curve, which means that you don't just put your money in and suddenly it's invested. There is this ramp up in deployment over time, and so it means that many of the pensions market funds have got lockups. You
mentioned about the deployment can take time, but for the investor, they're fully invested at point of investment.
Yeah, exactly. And I mean, that's been one of the age-old challenges of more retail investment in private markets, is that, the traditional structure of private markets wasn't very retail friendly. 10-year life lockups, lock your money up for 10 years. Drawdown, we're going to invest it in 3 years, and then you might start seeing some money back in after year 5. And then obviously the minimums that we've spoken about. So I think what the LTAF does is start to break down some of those key challenges with minimums. It's more of a mutual fund type structure where you have one capital call. You go in at NAV, you come out at NAV. That's the structural innovation that is taking place to allow a broader selection of investors to get involved. I guess the one thing that often I get challenged on, and this going back to your point, Melissa, around open-ended funds and illiquid assets, it does always raise the question, particularly when I'm speaking to advisors around the UK, of liquidity mismatch. Haven't we been here before? Didn't we see property funds gating? Haven't we seen the W word, which I won't mention? But there are preconceptions here that are baked into this market, which I completely understand, and they are very legitimate questions to be asking at the outset if you're an advisor, particularly if you've had live experience of those problems that have occurred in the UK market. What I would say to that is that the FCA has looked at these in a lot of detail. There's been a lot of review, particularly of the property funds, lots of reports, scrutinizing, in a lot of detail. And the way that the FCA has approached this is to change a couple of things and to enforce a couple of rules that try to address that liquidity mismatch. So things like you have to have at least monthly dealing. So you can't have a daily dealing LTAF. You can't have a weekly dealing LTAF. It has to be at least monthly. We're seeing a number of them quarterly and some 6 monthly.
Okay.
You have to have at least 90-day notice periods on redemptions. So what does that actually mean in practice? It means that if you want to trade in the end of March window coming out, so quarterly redemptions, you want to come out in March, you'd have to tell the asset manager before the end of the previous year. So there's that 90-day window, and that's super important because it means that it gives the asset manager visibility to be able to adjust what they're doing in the portfolio. So
it's more controlled,
it's much more controlled, much more visibility around flows than you would have had clearly in a daily dealing fund. And then the final, and this is the absolute critical point to understand when we've been through a number of FCA submissions, this is the bit that really gets scrutinized as well as valuation, which is something we can also talk about, is that the liquidity of the LTAF of the underlying liquid assets must match the dealing terms, the redemptions terms. So you can't just decide, my dealing terms are X because that's what I want them to be, and that's what the market wants them to be. They have to align specifically to your analysis of what's the liquidity that my portfolio could actually generate. So I'll give you a really quick example of the private equity fund we run, because we've been running it for 6 years, in almost the identical dealing terms. It's monthly in, quarterly out, it's got 90-day redemptions. What these funds do, they actually cap how much can come out per quarter.
So this is the gated.
This is a sort of a redemption limit. So this is another feature that has been introduced to try and mitigate this liquidity mismatch. So we ran an analysis of the last 20 years of our global private equity portfolio. These are the investments that we've made, and we looked at how much money comes back from that portfolio in us actually selling the unlisted companies. And it's somewhere, if you look at the analysis, and if anyone listening to this and wants to see the chart, we can send them to it to verify this. If you look at the quarterly cash flows from selling companies, it's and you put a line through it, somewhere near 5 to 10%, which means that if I set a quarterly redemption cycle with a 5% limit, I can be pretty comfortable that in a normal market condition, based on my analysis, I can satisfy that 5%. And I think that's the thing to think about here, is that there is an alignment between dealing terms and liquidity in a way that just wasn't the case in some of those other examples that I gave. And there's also a number of other protections around liquidity, like the at least monthly notification periods, that I think where the FCA has got to is a really solid structure here that allows illiquid assets to be used within an open-ended fund. The final point to make on this is, it doesn't suddenly mean that they're super liquid.
No, and I think that's the key aspect.
And this is the absolute key thing to understand. Is the LTAFs will not be for everyone.
But it is in the name, long term, isn't it? It is a long term holding.
It is, but I think you have to, if you think of that, I think we'll come on to a question similar to this. But if you're thinking about the spectrum of different liquidity profiles, you can access private markets in the UK. Traditionally, it was you could use an investment trust.
Yes, I was going to bring on to investment trust.
Trust. So that would be a daily traded on the stock exchange, but with access to illiquid underlying assets, but in a format that is very well suited to managing that illiquidity. I've come from an investment trust background. I still advocate strongly for the investment trust market. You then had what I described, the 10-year life lockup fund, which was what lots of the more institutional investors are using. What we have in the middle now is this semi-liquid fund, which I would actually put closer to the illiquid lockup fund than the investment trust, because these funds give you liquidity in most market conditions, but not in all market conditions. And there are situations where these funds will suspend redemptions. And we should go into this eyes wide open. And it's super important down the, when we're thinking about how an advisor or a discretionary manager talks about this to the end client, I think that's got to be the starting point. That is, you should only invest in these products if your client has a propensity to take on a decent chunk of illiquidity in their portfolio, which does mean that when we're having initial conversations, that these are investments that seem to be most suited to higher net worth investors, or even younger investors who have pensions that are super long term in nature.
They've got the time on there.
Rather than someone who is going to have a liquidity requirement in the next 5 years, because ultimately there could be a situation where they can't access that money.
Exactly.
Well, and I guess that's where hopefully going forward you're going to see more portfolios being push towards what we would call alternatives. For the younger generation particularly, and they seem to have an appetite more for it, don't they? I mean, I think that's the other thing.
They absolutely do, and I think it's really interesting. We've been in a lot of dialogue over the last 3 years with LTAFs, with the FCA, with the Treasury, with the industry, government bodies, the IA, the AIC, you name it. We've been having conversations in the industry about this. And what's really quite evident is that in the UK, and this goes to Mansion House and all of a lot of the government policy and how we're trying to reform policy in the pensions market, is that risk taking in the UK is low.
Yes, very low.
When we've got, if you think about the money that sits there, the hundreds of billions that sits in ISA products, half of it is in cash ISA still, right? And there's a decent risk of having all of your money in cash because inflation is eroding it, right? In the same way that illiquidity is another risk that you're taking by investing in a private markets portfolio. But I think what we've got ourselves to is a point where we've built a market around liquidity and requirement for liquidity, and because of some of the crises that I've mentioned, there has been reform and policy that has pushed investors towards liquidity. And for many investors, don't get me wrong, a fully liquid portfolio is exactly where they should be, but not for all investors.
Particularly the older generation as well, I think. And I feel that the younger generation, there's crowdfunding. They've actually had a lot of success sometimes in the more illiquid, the way a lot of innovative companies are coming onto the marketplace now, they're not necessarily listing, and therefore that does give the younger generation the opportunity to come into these sort of products and start to sort of see long-term upside, hopefully, going forward.
Yeah, and I think it's doing that and this is where the FCA has been coming from with their LTAF policy. If you look at their policy statement, they're trying to balance this. They're trying to balance between not reducing the investment universe.
No.
Well, giving the fullest investment universe possible to the broadest number of people, but also making sure there's the important consumer protections in place to make sure the wrong investors who don't understand what they're investing in go into those products. And I think the LTAF strikes a nice balance because it's a regulated product. It's really clear. There's summaries, there's risk warnings that you have to show to an investor. Even if they're advised or discretionary, to highlight these might be higher risk. There's a chance you might be not. There's illiquidity involved. Which is, I think, it balancing that is super important. Go to your point about a younger generation wanting access to these types of investments. If you think about what you're getting access to in some of these products, venture capital,
which is our sort of space.
Venture capital. Your VCTs are a great way of getting access to very small UK companies. VCTs and the funding that has given to early startups in the UK, like EIS and SEIS, it's been super important to developing fantastic UK-based businesses and driving innovation on entrepreneurship in the UK. But we also then need the second phase,
and that's always been
that's the bit that's missing.
That's
missing because what ultimately happens at the moment, and
everyone believes.
Well, it's because a lot of the venture capital funding sits in the US.
Yes.
And so the best US venture capitalists come to the UK. They look around at some of the best UK early stage companies, and then they invest. And then clearly, when they go for an IPO, if they do, then they take it back to the Nasdaq. So I think it's pretty familiar territory in terms of narrative. But I think giving for younger generation who want to get access to some of the most exciting companies, the LTAF gives that LTAF as an example gives exposure to that next stage of fundraising. It's slightly larger businesses. You don't get the tax benefits of a VCT, but you do get exposure to a slightly de-risked
because they're further on the journey.
And you're diversifying your portfolio, aren't you?
And
so you've got both the public and private marketplaces.
Yeah, and then if you think of some of the other examples, maybe you don't want to take as high a risk as venture capital, but you could want to get access to UK infrastructure, and that's another productive UK asset that the government is really trying to drive private capital into. And you're putting money into something that's going to help us generate green electrons and fund the get us somewhere to hopefully at some point towards net zero targets.
So it's interesting because you mentioned earlier the FCA doesn't absolutely define those. Is there a private market asset that's more suited to the LTAF, or what have we seen so far in the marketplace?
It's a really good question. I don't want to say there's one that's more suited because it comes back to the fundamentals of how did you build these products. Yeah. And it goes back to that point I made of you must align the liquidity underlying assets to your dealing terms. Because so give you a really good example, the venture capital LTAF I just mentioned, that's got quarterly dealing, but it's got a 5-year lockup.
Right.
Okay.
And then it's got a 2.5% limit per quarter that can come out rather than 5.
Yeah. Right.
And that is a really clear example of it's the most liquid asset class with the least clarity of regularity of distributions. Yeah. So therefore it's got a long lockup because it's, there's a big J curve. It takes a while for these companies to get to the point where they're going to distribute capital back. And then when they do, it's going to be more variable so that is set at 2.5 rather than 5%. Yeah. You think about something like infrastructure. Operating infrastructure has got a cash flow. Yeah. Often they have contractual cash flows, so often government-backed subsidies, where we can look 10 years into the future and be relatively certain that we're going to get this type of return. Yep. That is much easier to model on a cash flow basis than it is to model a venture capital fund. So you could argue that more cash generative, regular cash flows like maybe private credit or infrastructure, to a degree real estate, income real estate, could be a good place to build LTAFs. Are you trying to create capital growth? Is it income? How liquid can your client portfolio become? Because if you're buying a venture capital LTAF, that is probably going to be more liquid than an infrastructure LTAF, which, as I say, has clear cash flows coming back.
And I guess that it makes sense then why the FCA has taken that approach with that framework, rather than saying these are the terms of every LTAF. It's got to be based on the underlying assets in the LTAF. Yeah,
and they're giving flexibility because you could. So I haven't mentioned this yet, but LTAFs will also hold a degree of cash.
Yes.
But again, in terms of managing that, sort of squaring that equation of illiquidity and the liquidity of your assets and the dealing terms, you could hold more illiquid assets and then more cash, right? Yep. So the rules say you have to have at least 50% in long-term illiquid assets. So you could have 50% if you really wanted to, and that'd be a super liquid LTAF, and then you could probably do monthly in, monthly out.
A bit of drag on performance, potentially.
Yeah, it'd be a huge drag on performance, and you wouldn't do that for that reason.
So I was going to move on to investment trusts, which we touched on a bit earlier. And that naturally seems to be a comparison for sort of our advised market listening. Where would you see LTAFs coming in line with investment trusts and sort of the comparison?
Yeah, so I think the first thing to say is that I don't think either structure is better than the other. Okay. They're just different.
Yeah.
Just to maybe pull out a couple of the similarities and differences. So investment trusts are listed. Yep. So that means that they trade on the stock exchange daily. That means that you get daily liquidity. So you can trade in and out when the market is open. Yep. And that's great for many investors that want a fully liquid exposure to private markets or alternatives. And that's been long been a way that many wealth managers have got access to private markets. So that's great. Liquid access to private markets. The slight challenge, and this has been a bigger challenge in the last couple of years for the industry, is that with the trading, you get volatility. So I think that to pull out one really clear example, many investors used real estate or infrastructure investment trusts as diversifiers, and the experience over the last couple of years has been they haven't been particularly diversifying in times where equities have gone down. Right. So there's been a relatively high equity market beta between investment trusts, even if they are infrastructure, real estate, to global equity markets, and that's because they're listed on the stock exchange.
They become more correlated.
So and over the long term, you'd expect those correlations to iron out, and on a 10-year basis, you might see the diversifying nature that you would expect. But in the short term, that's not been the experience that many advisors, discretionary managers, and their clients have experienced. So again, pros and cons: volatility versus liquidity. LTAFs are the opposite. So, less liquid, monthly in, quarterly out, could become illiquid at a period of time, but you get priced at NAV, and they only price monthly.
Yeah.
So you get what I would describe as a more pure play private markets exposure. So, when I say pure play, I mean more like what a institution would experience in a 10-year life lockup vehicle. But the other side of that is you might not be able to get your money back tomorrow. Well, you definitely can't get it back tomorrow. You might get it in a quarter. So just different types of structure with different characteristics. I guess the other thing you could say is the investment trust market is more developed, so there's more offerings. So there's 80 billion pounds worth of AUM in investment trust alternatives across all different segments. In the LTAF market, it's still a market that's emerging. And so we'll likely see lots of new wealth LTAFs in the next 3 years. But at the moment, there's only a small number that you can choose from.
And how long does it take for an LTAF from idea to actual reality?
I think it depends how good your product development team is, I think. But, so just to give you an example, obviously we did the first one, the first specifically wealth-focused LTAF, and that took us probably close to 18 months.
Oh, wow.
Right.
But that's because of the first one. And I think it also depends whether you already have a prospectus set up or not. So to do a new LTAF prospectus, the FCA gives a 6-month guideline as to how long that will take to go through. Once you have that set up, you can then launch new LTAFs under that single prospectus, and then it becomes a month. So for us to launch a new one, it would be a month, and then decide on the idea at the start, make sure it holds up to scrutiny, and then there's about 1 to 2 months before you launch a product after it's been approved by the FCA. So you could probably do it in sub 6 months now. It took us a 18-month period because it was 6 months to do the prospectus and then big chunks either side. But it will get much faster, I'm sure.
But I was going to ask, in terms of demand, I mean, one thing we feel is that there is a lack of understanding and education, isn't there? Do you think that's something that's beginning to change? I mean, obviously, podcasts like today, but I mean, is that something that you think is really sort of one of the big barriers in the uptake?
So I've said repeatedly over the last couple of years, there's 3 things that need to happen for the LTAF market to scale in the wealth market. One is demand, because we can, unless our clients and investors actually want to buy private markets, then we're not, there's not going to be any scaling in the market. The way that demand is generated is through education.
Education is key.
And there's a huge amount of work going on there across the asset management industry. I spend most of my days talking to advisors about what private markets is, how the market's grown, why it's interesting from an investment standpoint, and also critically a commercial standpoint as well. So I think there's some really clear reasons why there is growing demand, and I can only speak anecdotally because I don't represent the whole market, but the number of conversations in terms of how developed they are is increasing rapidly, and where most interest I'm seeing is in the advisory market, where advisors have high net worth clients. They want to enhance the proposition. Generally, they have a model portfolio or a multi-asset solution across their whole book, but have a number of maybe multi-million pound clients who are super important to their overall business, and they're seeing competition coming in, quite frankly, from some of the large banks who are currently going round, opening offices regionally and competing for high net worth business. So I think first in area of significant interest we're seeing is from higher net worth advisory books, even where they're not just high net worth. It's a how do I maintain that client and compete against the competition that's coming into the market who do have a sophisticated private markets proposition. So it's almost like I need something here to take to market now. So there is genuine demand there. We've got many anecdotal examples of where we're expecting money to come into our LTAFs via that channel. The other side of it is that if you look at broad market surveys, education is definitely starting to come through, but there's a long way to go. There was a research and finance study on the UK market which came out a couple of weeks ago. There was a question around how familiar you are with things like LTAFs. That had doubled in the last year. from like 30% familiarization to 60.
Okay, interesting.
So that shows you that the education is starting to filter through. We're still only at 60, right? That's 40% of people who still didn't know what it is. So there's still work to do. But I think there's a huge amount of education still to do on, the structures, the regulatory regime. How do you even access? So what platforms can you access private markets on, like LTAFs? But also just critically the investment case, because we're never going to have significant demand unless the investment case stacks up. Because ultimately you only will take on illiquidity in your portfolio if you think it's going to give you some sort of premium, right? And so the demonstration of returns is going to be super important. So that was one. Demand and education around it. Market infrastructure needs to align. So that is, quite frankly, platforms. It is, there is going to be a requirement of tech build out, quite frankly, for many platforms in the UK if they want to offer private markets. Not all of them will.
No.
But we are already seeing forward thinking platforms put money aside to do development around technology. So it's not a if this is it's not if this is going to happen. It's when it's happening. When it's going to happen. So it will happen in the next year. Almost certainly. So it's happening. So I think there's more work to do there, but it's happening. Then the final thing is regulation. So we need a regulatory environment that supports access and has effectively removes barriers from the market to allow the market to then build the infrastructure and the demand to flow through the market infrastructure. There's been a huge amount of work on regulation. I know it's always people's eyes sort of blur over when you say the word regulation, but it has been super important here. And most recently, we've seen LTAFs made available in stocks and shares ISAs. So that's going to hit April 2026. And that's a super important move in regulation.
It's quite a milestone, that, isn't it?
Because we've been, we are, I'm sure, along other market participants and asset managers have been talking to the regulator about this a lot, and the Treasury, and it makes a lot of sense to have LTAFs in a stocks and shares ISA. They were in an innovative finance ISA. I think the difference between assets in those pools is 35 million to 350 billion. So putting it in the innovative finance ISA was not going to really fulfill the government's objectives of driving private capital into UK productive finance. Stocks and shares ISA might have a chance. So I think that's super important. The final thing on regulation that I think we're still working through is the SIP market. So wrappers need to work across the board, because most advice businesses I've spoken to, they use a collection of offshore bonds, ISAs, SIPs, you name it. There's lots of different wrapping of vehicles, and that's just how the market works, and that's how portfolios are optimized from a tax perspective. And we need SIPs to also work. And currently, we've been doing a lot of work on the SIP market, and I think there's a number of barriers that still sit there. We had a roundtable last week, for instance, with a number of the largest SIP providers, who, we were just talking about the challenges that still exist in the market, and quite frankly, there's lots. And so that's the next step. Is we've got ISAs working, we've got a great structure in the LTAF that facilitates access. We now just need to work on the final piece of the puzzle, which is the SIP market, which is a 500 billion sterling market, which currently has effectively zero in private markets. And if you think about all the work that's been going on in the defined contribution space, where Mansion House signatories have said we're going to get 10% into private markets by 2030, of which half of that is going to be in the UK, which I think opens up something like 50 billion of capital for UK productive finance assets, venture capital, infrastructure, real estate. It makes a lot of sense for that to also be the case for SIPs.
No, that's fascinating.
We'd love to get you back in.
Yes, and I
think
happy we're going to do some more sort of bite-sized bits on the private markets and particularly LTAFs. So it's been absolutely brilliant. And yes, exciting times, I think.
Very excited.
Thank you for having me on.
Thank you for the information. It's been great.
Very welcome. Thanks, James.
Thanks.
To hear more, tune in to either YouTube on video or all good podcast channels.
This is a podcast produced for EIS Platforms Limited, trading as growthInvest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments, and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.